All right, it's preparing live stream. Then I'll have us go live on the other places as well. All right, cool. Yeah, I just got a YouTube notification that we are good to go. And I'll have us go.
These invisible hearing aids could change your life if you're suffering.
Okay. Cool. Well, thank you guys for tuning in. We're just going to let this build up for a few minutes. So if you guys are watching this on the replay, we highly appreciate it. And just know that you can fast forward it a couple minutes as we wait for more people to join the show. But what we're going to do today is we are going to film probably either 2 or 3 reports, depending on time. And some of the things we have to talk about today, let me see here. We've got what is going to be the catalyst for the next big short, and that's as Dr. Michael Berry from the movie The Big Short. He sees potential catalysts that are out there, and I think John and I agree on these catalysts. So that's one of the topics of discussion. Another topic of discussion is upcoming recession warning signs are flashing red, and we'll get into that as well. And then if we have time for it, we're going to talk about how different former Fed chairs and former Fed governors like Bill Dudley are openly trying to sabotage Donald Trump, and also get into how Alan Greenspan is talking about how it's only basically an inevitability before we have negative rates in America. But as we're still trying to get things live over here, one thing that I do want to point out is that especially for people on World Alternative Media, if I just got this going actually yesterday, so I do have my own YouTube page that only has 159 subscribers, so I would appreciate any love over there. But what I did is I just uploaded what I'm sort of trolling Peter Schiff on this, but my Tim Picciott was right video, where I have a whole bunch of different calls that I've made on video over the past 3 years. I have a very good batting average on that. And then I've got some featured videos. One of the Trump effect and why good news is bad news. This was made the week Trump was inaugurated, and it's even more timely today than it was back then. Got one, we were all slaves to central bankers. Have ones that basically destroy the myth that Obama was good for the economy. Another one that destroys the notion that Clinton was good for the economy. So I appreciate any love over there, because this is the first time that I've ever sort of organized everything into one place. Still working on the organization, but we're getting there. And then I'd actually even more appreciate it if you guys shared the love on BitChute, because we've got I think I've only got like 50 subscribers on BitChute. I have one video that just passed 1,000 views yesterday, which which like in BitChute terms is like 1 billion views. As John, can you see that we've got people watching us live now, or can you?
Yeah, it doesn't show anybody right now. Actually, it's 0. But here we go. Okay, so I got it on my computer. Let me turn it off on my phone here. Just a second, because my phone was saying we had nobody watching us. So let's hear. We got about 20 people watching us currently. So yes.
Yeah, so we'll get this kicked off in a little bit, and definitely appreciate you guys who are with us. Like I said, we're right now basically, and actually, you know what it has? It has got a picture of Josh up there. So maybe we're, let's see if there's a way where we can. It automatically put a picture of Josh as a thumbnail. So I know he's probably going to say something. Actually, you know what it has? It has got it up, and when I tried to change it, it went. And all right, so what I'm going to do is I'm going to try to change the thumbnail before we get going, and we can get going on this. But definitely appreciate you guys joining us. And all right, where does it let you? All right, here we go. Here's the thumbnail. Change. Yeah, it just must automatically default to what the last one that we used was. WAM. Okay, well, all right, we got that changed, so at least now it's better than a picture of Josh. So at least it's not false advertising. That's what we really don't want to do here. But yeah, what we're going to do is we will take questions in between the different segments. We've got 2 or 3 segments we're going to shoot. At the end, we'll take a few questions. So we're not ignoring you guys. In the meantime, it just makes it really hard to edit if we don't do it that way. But John, do you want to get started with the show, or do you want me to start it?
Just 1 second here. I'm just sharing it, so we got it out here. Just 1 second here. Okay. Yeah, I'm just publishing it so more people will see it, so more people will join us for our live news. Yeah, I see it's still Josh on when I post it. So okay. Yeah, I see. There's people,
We already have
chatting.
one thumbs down, so thank you for who's ever already doesn't like it before we even got going. So appreciate that.
That's great.
Probably
Well,
helps.
yeah, we could see that we're having people joining us now. We have a couple of people chatting. So yeah, I think let's get started with our first report, Tim, and then we'll take some questions, in between our reports.
All right, just give me 1 second, because of course I think I've got two screens that have about the same info on it, but one of them has highlights. Okay, I've got my highlights back. Cool. All right, do you want me to get kicked off, or you kicking off?
You get it started, Timmy.
All right,
And,
here we go.
we'll have at her.
All right, I'm just waiting. Okay, now it's on me. Hey guys, this is Tim BitChute with World Alternative Media, also joined by John Sneisen. And today we're going to talk about what is going to be the catalyst for the next Big Short. Now, a lot of you guys probably love the movie, The Big Short. If you haven't seen it, I highly, highly, highly recommend it. It was one of my favorite movies. I think I paid for like 20, 30 people to go see it at a client event. But Dr. Michael Burry of The Big Short says he has found the next market bubble. And what he's talking about in terms of market bubbles are passive investments are inflating stock and bond prices in a similar way that collateralized debt obligations, or CDOs, did for some prime mortgages more than 10 years ago, Burry told Bloomberg News. Like most bubbles, the longer it goes on, the worse the crash will be, said Burry. The theater keeps getting more crowded, but the exit door is the same as it always was. All this gets worse as you get into even less liquid equity and bond markets globally, he then goes on to say. And what we've seen is that this, it's going to have a very big catalyst for when, to help have the market go up, but also it's going to lead to have a quicker downfall when the market inevitably goes down. And basically, the longer this goes on, the worse it's going to be. And you even got guys like Jeffrey Gundlach of Double Line Capital said that this creates a herding behavior, and right now it's reaching a mania status. Now he also goes on in another article to say, and let me pull up this article over here from Zero Hedge, but he goes on to say, in the Russell 2000 index, for instance, the vast majority of stocks are lower volume, lower value traded stocks. Today, I counted 1,049 stocks that traded less than 5 million in value during the day. That is over half, and almost half of those, 456 stocks, traded less than 1 million during the day. Yet through indexation and passive investing, hundreds of billions are linked to the stocks like this. The S&P 500 is no different. The index contains the world's largest stocks, but still 266 stocks, over half, traded under $150 million today. That sounds like a lot, but trillions of dollars in assets globally are indexed to these investments. The theater keeps getting more crowded. Okay, we already said that quote. And in the end, this is not going to end well. Potentially making it worse will be the impossibility of unwinding the derivatives and naked buy/sell strategies used to help so many of these pseudo match flows and prices each and every day. This fundamental concept is the same one that resulted in the market meltdowns in 2008. However, I just don't know what the timeline will be. Like most bubbles, the longer it goes on, the worse the crash will be. And what he means by indexing to let's say like the S&P 500 is a lot of times these big funds, and I'm not going to name any, they don't actually have that underlying stock. What they have is a derivative tied to the stock. And so really eventually when you are trying to, when the music stops and you're looking for a chair, you need to make sure that you still have a chair. And so what do you think, John, when it comes to, passive investing and how people are just, pouring into things willy-nilly, and ultimately the effect that that's going to have on the next market downturn that we see?
Well, the problem is that we see a lot of the, this inflow into ETFs. It's become extremely popular. And of course, that is a derivative of the real thing. And depending on, how much underlying assets you have in that ETF pool that you're investing in, now you could be in the same risk as you are with gold and silver, where you're looking at over 200 contracts to one physical metal. If you go and run for the doors, only 1 out of 200 guys will get the physical metal. And people don't really understand the risk of, derivatizing everything that you're looking at, and especially in the stock market and commodities and so on. You're making it available for people to commit those frauds by outputting a lot more, basically creating a printing scheme like we have with our current fiat currency system, and you making it available for people to commit those scams. These big fund managers, they could create more and more ETFs as the demand is there, but still you might have the same amount of assets if there's any back in them. So that is the risk that you will see in those funds, and you know, I see that as a solid risk. It's definitely something that, like, who actually like owns what, and we could only look at Japan and see how they actually bailed out most of their ETFs. The Japanese, well, the Bank of Japan owns 86.11% of all the ETFs because they had to bail them out. They were failing. Are we going to see something similar here? Potentially, as we see, you know, the guy that wrote the Big Short here, you know, the main guy that saw what was happening in 2008 and bet against it in about 2006. He's seeing the same thing again with ETFs there potentially. And as I said, Japan seems to have seen it already, where they actually had the central bank had to come in and buy up most of them because there were you know, overly crowded, as he was saying in his comment there. So I think that's a definite risk here, Tim, that you could see something like that happen, because any time you have a structure that you create where you could create more physical, more assets than the underlying asset, it's a huge risk. And of course, it's very tempting for the you know, the companies and whoever creates these funds to create more, a little bit more of these you know, shares that they have in their fund. That they might not have, you know, at all anywhere near the backing of physical assets in the background when, you know, people are running out of these funds and wanting to liquidate themselves.
Yeah, and you were so good because we didn't even really have too much of a, you know, pre-prep meeting, as you guys can see that we were coming on here. And the very next thing that Dr. Michael Berry talks about is, ironically, and that's actually the word that starts off with, ironically, the Japanese central bank owning so much of the largest ETFs in Japan means that during a global panic that revokes existing dogma, the largest stocks in those indexes might be relatively protected versus the US. And the reason for that is just what John was going on and saying, is that if you have Japan going in there buying, and it's funny, I was going to ask you, I was trying to look up what the percentage was, and then boom, like Rain Man, you just go and give us the percentage as I'm going to look it up.
It might be slightly different now, but it was like that when me and Josh reported on it about
might be like
7 months ago or something.
or maybe now it's 95, who knows?
But definitely it's around there, yeah.
But that distorts everything. And really what happened, if you take things back into 2014, October is when the Federal Reserve stopped printing money. And then about a couple weeks later, then the Bank of Japan massively starts printing money, and the Europeans massively start printing money. And it's like this hot potato that gets thrown around globally to see whose turn it is to bail out the system. And with Japan, you know, owning all of these ETFs, you know, people can, you know, the only criticism, you know, basically somebody could say of me is that I thought that things were going to crash a little while ago. But guess what? I didn't think we're going to have $17 trillion of negative interest rate bonds. I also didn't think that, you know, when you do something, you know, like, okay, you've got the Bank of Japan who just goes and just makes, you know, 56 billion yen, you know, worth of, or 56 billion US dollars worth of stock purchases in a year. Well, that's going to have a gigantic effect on the market. And what it is that is actual fascism. It's a point that I've been making for the past 4 years right now, is that people talk about, you know, Antifa wants to talk, you know, they're the ones who act like the fascists, calling everybody else fascist. Meanwhile, Bank of Japan, that is actual fascism, where you have the state basically corporate ownership of the companies by having a central bank that purchases money out of thin air and then use that money to then buy up the assets, which is why you had, you know, founding fathers of America say, if you ever allow a private central bank to issue the currency and credit of this nation, we'll all end up homeless on the continent our forefathers conquered. And this is exactly what is going on. But getting, you know, it sort of got a little bit off track, you know, because of me. But what all this is getting at is that when you see people who are going into, you know, whether it's, you know, the SPY, and I am a financial advisor, so I'm not making, this is not a financial advice. This is all for informational purposes because it's in the news, because if I get the SEC to look at this, then I need to make sure I hedge myself with that statement. But if you guys do need an advisor, you can head to thelibertyadvisor.com. But anyways, whether it's, you know, Vanguard's, you know, S&P 500 fund or Fidelity's or BlackRock's or whoever, State Street, you have tons and tons of people who are just putting all their money in their 401ks and IRAs into these vehicles. And so if you're, let's say you have 1,000 hours a month going in automatically, well, you're just buying up all those stocks, regardless of who the CEO is, regardless of what the earnings are, regardless of any of the information that's really out there, because you're just willy-nilly buying the market. And that then creates, positive feedback where people say, oh, the S&P has been the best performing asset of the past, X amount of years. Well, notwithstanding Bitcoin, and, it depends on a longer time horizon, like 20 years, actually gold is ahead of the S&P 500 as well. That's a whole nother subject. But I actually do agree with Dr. Michael Berry that this is creating this herding effect where, it is magnifying how good things are going on. And if you take a look at and we'll get into this in a little bit on the next report, but if you take a look at the earnings of the S&P 500, those earnings have dropped down like a rock since December 2018. But yet the stock market is up a lot since December 2018, because since the earnings were bad, it meant that now that the Fed has the excuse to cut rates, in this whole feedback loop of good news is bad news. And then if we take a look at actually the Russell 2000, so I'm going to try to pull this up right now from Morningstar, but if we take a look at the Russell 2000 right now, what we're actually seeing is that we have the market is down 11% over the course of 1 year. And what people that aren't as astute will say, okay, well, it was down 11 last year and it's up 13 this year, so it's up 2%. Well, no, if you're down 11, you've got to go up 22% to get back to even. And so the Russell 2000 represents the, core American, kind of everyday, smaller, mid-sized company. So the companies that fall outside the bounds of the S&P 500. And so wouldn't you expect that those would be, rocking and rolling at all-time highs if this is the greatest economy ever? And the reason the S&P is so high is because what we just talked about, all that money that is automatically going in there, creating all these artificial distortions. So I don't know if you've got too much more you want to add to that, or if you want to maybe start getting ready to wrap up on the next presentation.
Yeah, I think we're ready to wrap up there. But just one last comment is, of course, the Russell 2000 is more broader and more of the actual corporations in the United States than the the big 500. So you're looking at a more solid measurement, if you can call it, of the strength of the economy. Because what we got to remember, in an economy, it's not usually only the big corporations that drag that drive the economy. It's a lot of the small and medium-sized businesses. They are the ones that are the backbone usually of a real good economy. And we're seeing less and less of them. They're struggling because of corporate interference in governments trying to regulate industries. And what we see is it's getting harder and harder for others to come in and compete into those industries. So it's a definite showing of that the United States economy might not be doing as well as everybody's telling us. And of course, what we got to remember too, that makes the stock market and everything go up here, is because it's not that good everywhere else. A lot of economies around the world are really struggling, and what we're seeing is, of course, like in 2006-07, a big ramp up in the strength of the U.S. dollar because everybody's flooding to U.S. dollar-denominated assets. So what you're seeing is basically a fake strength coming out of the panic that's happening with debt markets around the world. The Canadian yield curve has been inverted like 25 basis points for the longest time. And of course, Deutsche Bank and others over in Europe are really struggling. You see negative interest rates, which is basically a default. So there's a lot of misallocated, if you can call it, excitement about the economy when we should be more cautious and actually look at the real numbers that are out there and thread a little bit more cautiously than be like, hurrah, hurrah, the US dollar is doing fantastic. The US economy is at the top of its peak. Meanwhile, there's an underlying severe weakness in the economy that mainstream media doesn't like to talk about too much, because they're of course owned by they get their revenue, advertiser revenue from those big corporations that are providing these funds.
Oh, sorry, I just realized I was muted. But anyways, this is, I think, definitely going to be a big catalyst the next time there is a big downturn. But what I do want to mention too is that one way you guys can help support John is he does have 2 outstanding books that he has written. So you guys can head over to Amazon for that. Let me pull it up on the screen right now. But one of them is The End of Freedom: How Our Monetary System Enslaves Us, the Prepper's Guide to Surviving the Economic Collapse. And then we also have Canada, the Greatest Economy in the World. the facts you're not being told about your money, and how to protect yourself from the coming crises. So
you forgot the question mark.
I was gonna. I'm like, I don't know. Do I say the question mark or not? I wasn't sure if I was supposed to say that.
I was just joking.
But if you guys type in John Slice's name in on a search engine around Amazon, you will be able to find that, and that is a way you guys can help support us. You got all the links that we'll have down below that how you can help support Josh. He's getting back to Vegas today, then heading to Anarchadelphia, then going back overseas, so to undisclosed location. And then one other quick plug for myself, I just got this website up as well. So if you go to libertyadvisorshow.com or the Liberty Advisor Show or basically all the places, all the roads like that lead back to Rome, lead back to me. And what we're doing here is you can check out this through MP3 format on podcast. Check it out through links for DLive, which is our preferred live streaming, all the BitChute links, all the YouTube links, and then also have a link to my book that I have actually for free. Another way to get that is if you want to text Liberty Advisor, just one word, the number is 71441. So in the body of the message, just put Liberty Advisor and you'll be sent my book for free. And basically that book is on how they rig the inflation rate, the GDP data, the unemployment data, and I give tons of proof and examples, and don't just make claims that they rig it, but I show exactly how they do that. And originally I wrote that to dispel everything that was going on with Obama. And now, unfortunately, I've got to use it to dispel what's going on with Trump. So
government.
So I'm Tipicho, and we've got John Snyson with World Alternative Media. And until next time, find the truth.
Be the change.
All right, cool. I'm glad I always mess it up and do it backwards. But yeah, we still are streaming, so we'll see if we have any questions. Let me get my other screen up here that had the YouTube video up there. And do you see any questions yet, John? I think we had somebody I saw was asking about the big drop in silver today. That's Mick Meisty was asking why the big drop in silver.
Well, somebody's trying to say that I'm totally wrong about the Australian housing market. I'm not so sure about that. The Australian economy is really struggling because they had to cut interest rates, and what you're seeing down there is with the drop of 20%, 30%, depending on where you were. You saw just a fake infusion of cash again, and this is the misunderstanding that people have about the actual Australian the economy in itself is that you had a bubble because everybody indebted, everybody was getting into housing because the assets were just flying up in prices because everybody was going into it, basically hyperinflation. And that money didn't flow into the economy, it flowed into all the real estate. But of course, when you hit enough people so you couldn't indebt more people and they couldn't afford the interest rate that was super low at that point, and now you're really starting to struggle at 1.75. Back in the day, my dad he had 18 something % interest rates on his mortgage. So if you guys think that the 1.75%, we're struggling at 1.75%, that we haven't been, hitting a kind of a peak debt level. It's insane to think that, I'm totally wrong about this. All I see is that you're just going to set yourself up for an even worse bubble over in Australia by keeping this whole bubble alive, by keeping on, lowering the interest rates to zero. Then you should go negative like you are in Denmark, of course, where 22% of all the mortgages are negative, and then you'll see how great it is, because basically going negative means that you're defaulted on the mortgage. You basically are not thinking that you would ever have to pay it off. If you only pay interest, for example, on a mortgage, on a negative mortgage, if you only were to pay the interest off, you wouldn't have to worry because you're getting paid by the bank to have that interest. So basically it's just with the negative interest rates that are coming out there, and it will come to Australia as well, you see that it's basically default on that debt because you never be able to pay it back, and that's how it is everywhere. So if you think that, because asset prices are slightly up again and the housing market is starting to going better in Australia again, the underlying fundamentals is completely telling you that this is a very bad idea. And of course, they'll continue to prop it up because nobody is willing to actually deal with physical reality of boom bust cycles, and they'll destroy their currency over in Australia. And of course, the Australian Reserve Bank of Australia has been selling their gold as well to keep on, holding the record highs in gold prices in Australian dollars, from going through the roof. So yeah, no, it's you could disagree with me, but that's kind of my side of it. What I just told you is that maybe you should look a little bit more and just saying like, oh, you're wrong because the housing prices are going up again. I didn't say, by this date, they will go down X amount. I said that they will go down eventually, and that's what will happen. There's just no way out of it. When you have a Ponzi scheme and you keep on, pushing more and more people in at the bottom, you will eventually run out of those people, and that's what they did. But then they lowered interest rates, so now they had a little bit more people that could afford to be shoved into the housing scheme, and then you'll keep on doing that until there's nobody left. And of course, then you have an epic bubble that you're not going to be very happy about having at the end of this.
And it is fitting that we are having this discussion after we just talked about Michael Berry from The Big Short, because if anyone who saw that would remember that, he looked like an idiot for about, a couple of years, when in actuality, there's a lot of things going on where all these ratios are getting worse and worse and worse, and yet the housing prices and all the underlying assets for those housing bonds were actually increasing in value when that shouldn't have been happening. So I wouldn't be taking any victory laps right now on not seeing that prognostication come to fruition just yet. But John, do we have any more questions? I had a little technical snafu on my end, so I was trying to take care of that.
There's not too much else. I see something about Deutsche Bank having $82 trillion in euro toxic asset derivatives. They actually, if you look at their balance sheet, they currently have 43 trillion, which is less than that, of course, but 43 trillion is still a substantial amount. That's about, let's see, now let me do the math quickly. That's about almost 6 times more higher than the total GDP of Germany. So yeah, I think that's pretty dangerous. And talking about derivatives, let me pull up my the actual derivatives that they create on different assets. And what we've seen since 1995, automobile asset-backed security. So basically, that's a collateralized debt obligation where you put in all this debt into an instrument and then you sell it. The bank basically takes all their loans, put it in a special purpose vehicle or special purpose entity. Then they tranche all of these, maybe hundreds upon hundreds of these vehicles into one called a asset-backed security. Well, it was the collateralized debt obligation back in 2008, of course. And then what you end up doing is you sell this to the pension funds, to everybody else. And a little bit of warning, for example, on the auto bubble that we've been talking about, Tim. In 1995, these asset-backed securities, 1.16% was automobiles. Well, now you have 49.71% being automobiles. And you also have them on student loans. You have them on credit cards. So they're just taking the debt and then just offsetting it, selling it as something else. So basically using debt as an asset, which is insane. But of course, on the bank side, it's an asset. It's the liability to the borrower, of course. But again, you look at what blew up in 2008 in that he was talking about, Michael, was 13-point-something billion dollars in the mortgages that was underlying for these assets. Well, the subprime auto loans that's underlying here is about 84.4 billion. That is underlying of these asset-backed securities. So I think there's a little bit of a warning there. And of course, there's another warning where you have the collateralized loan obligations as well, especially in Europe with Deutsche Bank. I think Deutsche Bank and others, issuing these derivatives on top of corporate debt. And that's also happening in the United States, of course. Because these corporations have been borrowing money to buy back their own shares to prop up the stock markets. So there's a substantial amount of risk here. And of course, Michael, he saw that, firsthand in 2006, where, bells that were really starting to ring for them. And of course, a bubble could, sustain itself for a lot longer than, we think that would be logical and make sense. And a lot of more people will get hurt because it sustains that, longevity. So
the longer it takes, the more people that are going to get hurt, and the more right your people are going to end up being. So I wouldn't take any victory laps. But let's try to get another video out here before we have to get going. So the next one is going to be on the list of different recession warnings that we have. So do you want me to kick it off, or you to kick this off?
Yeah, I can kick it off. Sorry, can you say that again? What it was, Tim? I just
list of recession warnings that are flashing red. So I've got a CNBC article.
Okay.
I was going to reference.
Yeah. Are you ready?
Yep, I'm ready. I just wanted to have you say something, so that way the photo was on you. So
okay. Yeah. So let's get started, Tim. So, hi, everyone. This is John Sneisen from World Alternative Media, and today we're joined by Tim BitChute, the Liberty Advisor over in Arizona, and we are going to talk about some red light recession warnings that have been happening lately. And Tim, why don't you get into some of them, and then we're going to analyze a little bit and explain why there's some problems with something that it might not be the trade wars, it might not be a lot of the things that we hear in mainstream media, but there might be some serious debt problems that we have in the world economy. And let's hear about it, Tim.
Yes, thank you, John. So usually I don't use CNBC as my, bastion of truth, or, what I want to look to when I'm looking at financial news. But, they're almost always positive. I mean, you even go back to, right before Bear Stearns collapse, they were positive everything. Look at right before Lehman Brothers collapse, which was almost 11 years ago today. They were positive on that. But what they're saying is that data seems to be coming in from every angle that basically indicates you could have a upcoming recession. One of those indicators is the actual search term for recession is basically through the roof right now. So that's just, showing that it's kind of out there in the common zeitgeist. So this is now actually being a thing. And this is something that John and I talk about constantly, especially John, is the inverted yield curve and how that has always been a classic recession indicator. Then you've got the gross domestic product, or the GDP. I do have my problems with how they measure that, but however, that also is trending in a negative direction. And then this is something we mentioned earlier on our last live stream, was we have corporate profits. You take a look at where the corporate profits are from December of 2018 to now. I mean, basically in the toilet. However, the S&P 500 has gone way the heck higher. Meanwhile, the earnings are lower. And the reason for that is what I've been saying all along, is that bad news is good news and good news is bad news. So this bad news now gave the Fed the excuse to cut rates, and flooding money into the economy is quote unquote good news. And, it's more of the same for what we've been seeing, time and time again. And then we have the PMI manufacturing index has been declining. And actually, the number came in at the lowest number since September of 2009, the first time it broke the 50 threshold. So U.S. manufacturer growth slowed to the lowest level in almost 10 years in August. The U.S. manufacturing PMI, that's the Purchasing Managers Index, was 49.9 in August, down from 50.4 in July, which, that also was not a very stellar number. The reading is below the neutral 50 mark threshold for the first time since September 2009, according to the IHS Markit. Any reading below 50 signals a contraction. So boom, there you go. Then you've got the Cass Freight Index. That fell 5.9% in July. That was following a 5.3% decline in June, which also followed a 6% drop in May. And this is reading here a quote: "We repeat our message from the last 2 months. The shipments index has gone from warning of a potential slowdown to signaling an economic contraction," the July report said. Although the initial Q2 2019 GDP was positive, it was not as positive upon dissection. And we see a growing risk that the GDP will go negative by year's end. And then we have copper prices. So copper, which people also refer to as Dr. Copper, as a lot of times has helped signal recessions. And because, people use it, to build homes, and a lot of new home construction, as that's one of the big use cases for it. And that commodity is down 13% since the beginning of this year. And then contrasting that is gold has been soaring. So gold prices are up more than 20% since May. Some of that could be the U.S.-China trade tariff. I mean, a lot of that is probably because most places in the world you get nothing to hold on to your money, or in many cases you actually have to pay the banks for them to lend them money, which is just absolute utter insanity in my opinion, and I'm sure probably everyone that has a brain's opinion as well. And then we have the Global Economic Policy Uncertainty Index, which is even way the heck higher than where it was in 2009. I mean, we're at astronomical levels for this. And then you have business spending is down 5.5%. So these are just all signs that show that things are not as great as what people make them out to be. And so, John, what do you think about some of these classic recession signs that we had just mentioned?
Well, yeah, there's of course the yield curve inversion, Tim. That's a serious indicator, and what we see is another one that is also another serious indicator is the gold silver ratio. It peaked out about 3 months ago. It peaked out at 93 to 1, 93 ounces of silver to 1 ounce of gold. Well, now currently it's dropped down quite substantially, down to 82.58, and it doesn't seem like it wants to go back up again a lot. So what that tells me, every time you hit that peak in gold silver ratio and it starts dropping down, and silver is starting to move up and catch up to gold, there is a recession that's happening as well. So you got some serious indicators here that, you know, almost every single time has been available to us to watch these signals happening. And they're every single time. Basically, the gold silver ratio together with the yield curve inversion over the last 10 times that we had a recession or a market calamity, they've happened every single time by no different change at all. And this is what we see. We see these indicators, you know, are trying to tell us something, but nobody's really listening to these indicators. They're more, you know, looking at the flashy, green lights at the stock market. You know, looking at high frequency trading or just what's going on Wall Street as the real economy, which is really not. The real economy is people putting out products, people, you know, doing research and developments, people growing their business, not with debt purchases or by purchasing back their own stocks, but by actually producing something and growing because there's a need for their product. So what we've seen ever since 2008, when they printed over the default of the US dollar, we've seen that they printed up about 330% on the different central banks' balance sheets. That's the average of the 82 central banks that I measure, and that was between 2008 and 2018. So you see that they've increased their balance sheet substantially, and a lot of their balance sheets was a lot of bad derivatives, and it's all these bad debt that the bank basically have their customers defaulting on, but they're trying to hide the fact that happens, and then they're just brushing it over by printing more and ever more currency into the system, and it's just a vicious cycle that you can keep on propping up. But at one point, you'll have the most important part of a fiat currency system is the trust in that currency will falter, and at that time, when that trust falters, that's when the currency fails very fast and very rapid. And we've seen that throughout times. It's not just me saying that is a potential of happening. That's just a matter of fact that it happened over the last 50 times in just early, we're talking about 18, 19, and 2000s, the centuries. So we're looking at that happening in those 3 centuries alone. And every single time within a year, after people lost trust that the purchasing power of their currency would hold, it was gone. And that's just a fact. And that will happen again, no matter how much people think that they'll prop up the economy here. So yeah, we gotta keep on looking and telling people about what's happening here, all these numbers. Then they could keep on, printing their currency, and of course they could keep on, lowering the interest rates to prop up the system, all the debt that they need, so more people can get in, so they could keep on sustaining this Ponzi scheme. But at one point, you will hit, as you said, the negative. And in Denmark, there's 22% of the mortgages that are negative now. And by that default, so think about if you just pay the interest rate.
I'll say maybe that's why Trump wanted to buy Greenland. He's wanted to take out a negative mortgage.
Well, yeah, he's a smart guy. He's the debt man. He's not like Rocket Man over there in North Korea. He's the debt man.
He just tweeted out like a couple hours ago. I just saw right now that he goes, the economy is great. The only thing that's basically is adding uncertainty is all the fake news. So yeah, and he has some other quotes that we'll talk about in our follow-up video to this. But can I also just mention that we have, speaking of numbers, is the Atlanta Fed has GDP at 1.7% annualized rate in the third quarter. And what drives me nuts about this is when they said the rate was, I forgot at one point, I mean, they had an estimate like a year or two ago that it was at like 5.5%.
Yeah.
And I was telling everybody, like, listen, the Atlanta Fed is not your friend. Any Fed Reserve branch is not your friend. These people, like, so if you guys want to use that as the barometer to go by, be careful on what, dying on this sword over here, is because, what happens when they have, a rate like right now is at 1.7% is the newest indication that they have. And so, be very careful. All the people that are toting this number, from like 2 years ago at around, 5.5%. And another thing, just to give like the devil's advocate on this, because we were talking about all the people that are seeing a sign of recession. Well, one group that is not seeing a sign of recession, I'm going to try to pull this up on the screen right now, is Best Buy. So what Best Buy is saying is that basically they've had a lot of people who are taking out leases on TV. So here we go. If a U.S. recession was lurking within the next 90 days to 12 months, people probably wouldn't be leasing out big screen TVs and refrigerators at a nice clip from Best Buy. And throughout the second quarter, we continue to see customers use lease to own to acquire products across a wide variety of categories, with the largest being computing. We also continue to see a significant number of customers take advantage of the 90-day purchase option, which consists of additional payments plus the purchase price. And so to me, I mean, I don't know about, other people out there, but, if people are resorting to lease to own, well, it could be a good financial move. Hey, we'll have Best Buy float this for 0% and we'll just pay back a little bit every month, which is actually what I did with the computer that I'm streaming from right now. And it was actually this week last year when I bought the computer, but, I basically gave me a 0% loan. But for a lot of people, they're probably doing it because that's what they have to do. And so to me, seeing that lease to own is proliferating, especially on TVs. I mean, you can get like a 55-inch, 4K TV for like probably $300 to $400. I mean, and people have to then put those on like a 12-month like layaway lease to own. To me, they're using that as a, hey, this is a sign the economy is great. And for me, I'm using it as a sign the economy is not great. I mean, what do you think about that, John?
Well, it's when people go out and borrow or lease out, something that they used to probably go and pay cash for before. So think about it this way. Something came to my mind now is look at the lengths of the mortgages that are now. Look at the lengths of car loans that are coming out. Everything is becoming harder to be able to buy the same asset for the same amount of length, because wages are stagnant, because they're looking at the fake GDP numbers and the fake inflation numbers. They're not seeing the real inflation in the economy. So wages are, getting stagnant, and they're every year, that inflation is way higher than the actual wage increases. And now you're falling behind every single year. And at those points, that's why people need, instead of 2 or 3 year loans now for cars, they take up to 10 years sometimes at the worst end of it, because they just can't afford to pay for that loan anymore. And of course, the interest rates are really high, so that doesn't help at all on top of it. So it's just a financial decision upon bad financial decision that happens. And of course, leasing something is a sign that it's not people actually buying the physical thing right up front. It's people that need to have a payment plan in order to be able to afford it. So I don't know. Does that really look like a really solid economy to me? I dare to question that, of course. So what that people actually have less to be able to afford things with, and things are not looking that much greater in the economy, because you're constantly trying to prop up the economy. Meanwhile, people are falling further and further behind, because they just can't afford what they used to be able to afford again, and that's a huge problem, Tim.
Yeah, thank you. And it seemed like there was a problem. We were trying to use Zoom to go live, and I was sharing articles. Apparently, I think it got shared with you, but it wouldn't go. It's sharing a screen. So I do apologize for people that are watching on the live stream right now. But I do agree with that analysis. And it's probably. Do you have too much more to say about this, or do you want to maybe for the third video we were going to?
Yeah, no. Let's wrap it up there. So. Of course, the end game here is that you need to protect yourself. You need to be aware that things are happening in the economy. And if you look at things that are happening, and of course, this is my opinion, but if you look at the past, you see that, of course, gold and silver is great hedges against all this money printing because they have a set amount of supply that they constantly have. And we're not looking at the US dollar price of gold and silver, which is, faked by fake paper contracts. We're looking at other, currencies that don't have those fake ETF paper gold prices. They're more of a physical discovery of the price of the physical metal itself. And those are all up. So what that's telling me is that, gold and silver is a great hedge. Of course, silver, in my opinion, is always a fantastic hedge because the gold-silver ratio always catches up. Silver always catches up in a crisis to the real value that it should have. And that's going to happen yet again if, like 10 times over the last, 60 years is a record. Well, I think it will happen again. And of course, if you look at the 2013, you had also 2014, 15 in Greece, where you had capital controls coming in and problems with the monetary systems in Greece and in Cyprus, where you have bail-ins, the banks, all that stuff. You saw cryptocurrency was starting to take a foothold because they have cryptocurrency is very strong because it provides you a way of transferring value without the third parties that the banks, have done throughout the world history, and they controlled everything because they have been the intermediary, and now we're taking that away from them with these cryptocurrencies, and we're about to really engulf on a whole new era of freedom. I think if we can embrace that value that cryptocurrency has versus the enslavement of all these banksters and central bankers.
Yes, yeah, thank you for that. I was trying to fix one of the technical problems we have here, but I think we'll wrap that up. Just remember some of the ways you guys can help support us. We've got we'll have different links down below, ways that you can support John or Josh, whether it's through Patreon, Subscribestar, subscribing through float.app. We also recommend you guys check us out on BitChute as well. I have my own BitChute channel that I recommend you guys check out as well. As of 2 days ago, just got all the videos up there. Just had my own YouTube channel that we just got all my videos up on there a couple days ago as well. So it's just help diversify the way you watch us. Ideally, would not be on YouTube. I know I'm speaking to most of you on YouTube right now, but you can also support John by, he's got 2 different books out there: The End of Freedom, How Our Monetary System Enslaves Us, and also Canada, the Greatest Economy in the World, ? The facts you are not being told about your money and how to protect yourself from the coming crises. You can find both of those on Amazon, but Tim Cho and John Sneisen with World Alternative Media. Find the truth, be the change.
Okay, just 1 second, Tim. Let me just run out of the live stream for 1 second. I think Paul Krugman is over here. I got to talk to him and tell him to shut up about fractional reserve banking and Keynesian economics.
Yeah, and I'll try to see if I can fix some of these issues in the meantime. So what I'm going to do is I'm going to actually share the feed right now, and I think I've discovered why I was having problems with the share right now. Just 1 second over here. So can you guys on the live stream see where it says like WAM News live right now? I just want to make sure that you guys can actually see the same thing, because I think I know what I did to mess it up last time. So if I click the different articles, well, then I can't see if you guys are commenting that you can see, but just wanted to see if that was the problem that I had there. So if anyone could comment that you guys could actually see the screen when I was sharing that, would be appreciative, because I'm using a different program to go live right now. So you guys can see that. So that's a yes is a good thumbs up. I'm taking it. Yeah, just so you guys know what's going on. So we have, I'm using Wirecast to go live to DLive, Float, Facebook, Twitter, Periscope, a whole bunch of other places. And then on the other, and I'm using Zoom to go live directly to YouTube. So it was my first time using Zoom to go directly to YouTube. So it looks like, John, I have figured out what the problem was. But are you there? I see we've got your screens off right now. Okay, so looks like John's trying to take care of Paul Krug. Especially as we move through what's likely to be the reset this time. No more wealth transfers by these parasites. Yeah, that's the whole thing is, if people don't know what's going on, then what they're going to do is they're going to beg for their own enslavement. And that's why, in the book Creature from Jekyll Island behind me, you've got Paul Warburg, the creator of the Federal Reserve, said we shall have one world government. It's only a matter of it's through consent or conquest. And unfortunately, a whole bunch of people out there, when everything collapsed, are going to beg for the government to come in to quote unquote help them. And that's what ultimately the whole reason that I wanted to get involved in this was to make sure that that didn't happen. So that's what we're over here doing. And thank you, Rainy Steps, for the super chats. Greatly appreciate that. I know Josh will appreciate that. Yeah, so I think he is getting back to Vegas probably any time now if he's not already there. Then he'll be at Anarchadelphia and then back overseas. So he's been busy. That's why we're trying to help fill in some of the slack, and do appreciate everyone who's been receiving us well over here. So I do see John is back right now. He took care of Paul Krugman, told him to stop his fake alien invasions that we needed for the boosting GDP. And there we go. He looks way too good to be Paul Krugman.
Yeah.
His hair doesn't look messed up enough to be Paul Krugman.
No, she's too cute to be Paul Krugman. Krugman is not cute. She doesn't agree with it though. She's kind of angry at me now. But yeah, I think we'll wrap it up there, Tim. I know that we wanted to do another one, but I think my dog is a little too barky happy here, so it's not going to be quality content for our people watching. So I think Tim, we should definitely wrap it up here. We really appreciate, of course, as you said, Rainy Steps for giving some money. It helps. Anything helps for us here at WAM. So we really, really appreciate that. And Tim, if you have any final thoughts, to wrap up the live stream here, I think that'd be good.
Yeah, I mean, I think a lot of the final thoughts is that, this is all more of the same, that the good news is bad news. We've seen a lot of Hail Mary plays by central banks to help extend things, but ultimately will make those things a lot worse. A lot of these things I saw coming, a long time ago. We were hoping to do a video on the Federal Reserve where you have, former Fed governors like Bill Dudley coming out there and basically saying we need to, help, the Fed needs to basically sabotage the economy so that way, we can elect a Democrat. And that's all things that I had in podcast number 1 the first official one I ever made was basically saying that they were going to pull an Andrew Jackson on Trump. Or what I mean by that is that Bill, I'm trying to think of the guy's name right now. It was Nicholas Biddle, the second Central Bank of America governor at the time, or chairman at the time, basically, retracted the money supply that created a recession. And then since you didn't have, Twitter back in 1840, that then they were hoping that you'd have Jackson get the blame. And that I said that word for word in the very first podcast the week Donald Trump was elected. So I am not Monday morning quarterbacking any of this. And it's just so ridiculous to see, everything that, and unfortunately it was the Trump people who, which I was a gigantic Trump supporter. I mean, I even, I even made the website, defeattheglobalist.com, so I was, can't say I wasn't, very early to that party if I had that domain name. I had, Trump as my president shirt at one point, which I'm sort of embarrassed to admit now. So anyone who wants to say that I'm some like TDS, like Trump derangement syndrome person, I mean, I lost friends, I lost family for supporting him. I have a hat over there that I signed hat by Trump. I spent $250 on before the election, thinking that he would win and then thinking that he would be assassinated and then it'd increase in value. So I'm actually happy that didn't happen. It's been a lot of fun seeing these tweets that have been going on lately. But yeah, I would just, I hope you guys can maybe check out my Tim BitChute was right video that I had made the other day where I went through a bunch of different calls on video of the past 3 years. And I think that just a lot of that stuff is more true today than it was back then, especially the good news is bad news. And the big thing is, can they keep this economy going for the next, through 2020? Personally, I don't think if it were me and I was close to retirement or already retired or had a bunch of money in the stock market, I want to do things to election-proof my portfolio now and not wait on this, because we are playing with fire. But one of these options is, the Fed can print a whole bunch of money. Right now I made your dog mad by talking about all the money printing that's going on. And actually, one other video that we should do at a certain point is the central banks have actually been buying. The Federal Reserve asset sheet went up last week for the first time since 2014. So yeah, that's sort of a stealth QE program that's going on right now. I see Rainy Steps just donated $13.99 Canadian. So thank you that, because he loves the dog. So people love the dog. And, I've been rambling on right now. I just want to wish everybody a happy Friday. you know, and another reason why, you know, John, is there other places people can find you besides WAM's YouTube? Because I know that, you know, it probably is important that we diversify in case, you know, we aren't here by this time next year. Because when the election rolls around, you know, I don't think anyone that, you know, is spewing out actual truth and actual facts of what's going on is going to be allowed to be on YouTube or allow people to see them on YouTube. So, you know, is there other places people can find you and get a hold of you?
Yeah, no, definitely. They could find me on, of course, my website, which I have up now, which is theeconomictruth.org, where you could find a lot of my economic research. You could find everything about what I'm up to, my different involvements. You could find my reports. You could find my books. You could find everything that I put forward of content. And I highly suggest also you look up Infogram. .com and look up John Sneisen there. If you put in Infogram and John Sneisen, you'll find some substantial charts and content that I created to kind of show people what's going on in the economy right now. And of course, you can find me on Facebook at theeconomictruth.org. The Economic Truth. So you find a lot of my content there, of course. And then, of course, you will be able to find us on YouTube, BitChute, Float, and everywhere else that me and Tim are streaming all of our content here. So it's very important that you support alternative media, and it helps a lot for you know, people like Josh and Tim and me, that you are able to, you know, give a little bit of money, and we really appreciate, of course, Rainy Steps from I think it's Canada. So greatly appreciate that. That always helps, you know, makes us happy that we're able to, you know, provide some content that means something to people, and that we're able to monetarily, you know, get something for that, because that is truly great to put forward good content that people appreciate. So really appreciate that again. And of course, you'll be able to find a lot more of us. I might actually be going to a conference in November down in Nevada somewhere. So stay tuned for that. We'll have some more on that with none other than, of course, the guy we talked so much about, the Federal Reserve today, the guy that wrote The Creature from Jekyll Island. Ed Griffin himself, of course, is going to be at that event, and many others. So very much look forward to that. Just wanted to give an update that, you know, that's something that we have in the books that we're working on. And yeah, it's exciting times. Meanwhile, it's scary times in the economy.
And go there and bring your copy of Creature from Jekyll Island, and you might even get it signed. So I've got one signed from Mr. J.R. Griffin himself. Yeah, I think it was when I ran into him at a bathroom at Anarchadelphia, and I was like, wait a minute, I need to, like, I brought the book with me, just so like I figured I'd probably see him at some point, and you know what, it'd be a good memento, because he's not going to be around forever. And so, you know, to get those books signed while he's still, you know, here with us, you know, adding value, you know, I think would be a great thing to do. So, you know, definitely appreciate you guys, you know, especially, you know, through all the different, you know, live stream glitches and stuff that we're having. You know, it's not necessarily easy to go live, but you know, the more times you do this, then the better we get. And we just appreciate you guys. We've got John hooked up on the Blue Yeti mic too, so he's got some good audio, so we could hear the dog barks even better this time. And no, but I think that's probably it from my end. And I know you know, it's even later where you're at right now, but definitely appreciate all the support, guys. We'll be back probably with some videos next week as well. Maybe even do one tomorrow, but we'll see.
100%.
All right, take care, guys.
Yeah, have a good one, guys. Pleasure being around.